How the U.S.-Israel-Iran war is driving oil prices and hitting your wallet. Let me say something uncomfortable right away. This war is not happening over there. It is happening at your gas pump. It is happening in your grocery bill. It is happening inside your retirement account. Most Americans hear headlines about Iran, Israel, U.S. involvement, and they think geopolitics. Experienced investors hear the same headlines and think one word: oil. And oil is not just fuel. Oil is inflation. Oil is transportation. Oil is food prices. Oil is manufacturing. Oil is consumer sentiment. Oil is interest rates. And when oil moves fast, markets move faster. Right now, the biggest fear in global markets is not bombs. It is supply disruption. Because the Strait of Hormuz, one narrow shipping lane, carries roughly 20% of the world's oil supply. 20%. If that artery is even partially restricted, global energy markets tighten immediately. And when energy tightens, prices spike. We've seen oil surge before on conflict risk alone, without a single barrel actually disappearing. Markets price fear before reality. And here's what most Americans don't understand. Oil doesn't need to hit $150 to hurt you. Even a move from $75 to $95 changes everything. Why? Because oil is a cost multiplier. Let me explain. When oil rises, trucking costs rise, airline costs rise, farming costs rise, manufacturing costs rise, heating costs rise. Every product that moves, and almost everything moves, becomes more expensive. The grocery store doesn't announce Middle East conflict fee. They just raise prices quietly. Gas stations don't explain geopolitics. They change the number on the sign overnight, and consumers feel it instantly. Now let's connect this to the American economy. The Federal Reserve has been trying to control inflation. Inflation was cooling. Markets were stabilizing. Interest rate expectations were becoming clearer. And then this conflict escalated. Energy inflation is the most politically sensitive form of inflation in America. Americans can tolerate abstract economic statistics. They cannot tolerate $5 gasoline. When gas prices rise, consumer confidence falls, retail spending slows, political pressure increases, and markets become volatile. Now let's talk about Wall Street's reaction. When geopolitical risk spikes, money moves. It does not disappear, it rotates. Investors sell risk. They buy safety. Historically, in moments like this, capital flows into U.S. Treasuries, the U.S. dollar, gold, energy stocks. Technology stocks often wobble. Consumer discretionary stocks feel pressure. Airlines drop quickly. Transportation stocks weaken. Because investors know margins shrink when energy costs rise. But here's the deeper layer most people miss. The real market fear is not oil at $90. It's escalation. If markets begin pricing oil above $110, $120 per barrel, we enter a different economic conversation. At those levels, inflation could re-accelerate. The Federal Reserve could delay rate cuts. Mortgage rates could stay elevated. Housing could remain frozen. Credit could tighten. Small businesses could struggle. That's the domino effect. Now let me slow this down, because panic is expensive. The stock market has survived. Oil embargoes in the 1970s, Gulf wars, terrorist attacks, financial crises, pandemics. Markets are adaptive, but they punish emotional reactions. Here is what intelligent investors understand during geopolitical shocks. Energy spikes are often sharp, but not permanent. Unless supply is structurally disrupted long-term, oil spikes tend to stabilize. Speculators bid it up. Reality either confirms the fear or deflates it. The question every investor should be asking right now is not, should I sell everything? The correct question is this temporary volatility or structural change? If tankers continue flowing through the Strait of Hormuz, markets will eventually calm. If supply truly breaks, we enter a longer inflationary cycle. Those are two different scenarios. Now let's talk about your wallet. You cannot control geopolitics, but you can control your positioning. If you are an American household, 1. Expect higher fuel costs in the short term. 2. Expect grocery pressure. 3. Expect market volatility. 4. Expect headlines designed to amplify fear. Volatility is not new, but emotional mistakes are. Here are 5 intelligent actions during energy-driven uncertainty. First, do not panic sell diversified portfolios. Energy spikes are cyclical. Second, review your exposure. If your entire portfolio is concentrated in growth stocks sensitive to rates, understand the risk. Third, consider inflation-resistant assets. Energy producers historically benefit from rising oil. Commodity exposure can hedge inflation. Fourth, strengthen liquidity. Short-term uncertainty favors households with emergency buffers. Fifth, watch the Federal Reserve closely. If oil drives inflation higher, rate policy shifts. Rate policy moves markets more than headlines do. Now let me address something emotional. War triggers fear. Fear triggers urgency. Urgency triggers bad financial decisions. The market does not reward urgency. It rewards patience. If you owned productive assets before this conflict, ask yourself, has the long-term earning power of American business disappeared, or has uncertainty increased temporarily? Those are not the same thing. I have watched investors lose decades of compounding because they reacted to months of fear. Geopolitical crises feel historic in the moment. Most fade in long-term market charts. But the mistakes investors make during them last forever. Now let's talk about the bigger strategic layer. America is still the world's largest oil producer. That matters. Unlike the 1970s, the U.S. is not fully dependent on foreign supply. But global pricing still impacts domestic cost. Oil is globally priced. If Brent crude rises, American consumers feel it. Even if production is domestic, energy independence reduces vulnerability. It does not eliminate price transmission. And this is where investors must think structurally. If energy remains volatile, energy infrastructure companies may strengthen. Defense spending may increase. Industrial supply chains may shift. Global trade routes may reprice risk. There are second-order effects. Markets reallocate capital to where risk-adjusted returns make sense. This is not chaos. It is rebalancing. The key is staying rational while others react emotionally. Now I want to take you one layer deeper, because this conflict is not just about oil. It is about perception of stability. Markets hate uncertainty more than they hate bad news. Clear negative news can be priced. Unpredictable escalation cannot. If the conflict widens regionally, risk premiums expand. Insurance costs rise. Shipping costs rise. Global growth projections adjust. That affects earnings. And earnings drive stock prices long term. But here is the critical truth. Markets often overprice fear in the short term and underprice resilience in the long term. The American economy is not fragile. It is adaptive. But adaptation takes time. And during that time, volatility is inevitable. If oil stabilizes below crisis levels, markets will recover faster than headlines suggest. If oil surges into sustained triple digits, inflation math changes. That's the pivot point. Watch oil more than the talking heads. Watch supply routes more than political speeches. Watch the Federal Reserve more than social media. Energy drives inflation. Inflation drives rates. Rates drive valuations. That is the chain. If you understand that chain, you understand the moment. This war is tragic geopolitically, but financially it is a stress test for consumers, for investors, for policymakers. The question is not whether markets will move. They will. Let's move from headlines to positioning, because knowing what's happening is not enough. You must know how to respond without destroying your long-term plan. When oil spikes because of geopolitical tension, 5 sectors typically react first. Energy producers rise. Defense contractors strengthen. Airlines weaken. Consumer discretionary slows. Interest rate-sensitive growth stocks wobble. That's the short-term rotation. But here is where most retail investors make a mistake. They chase what just moved. By the time energy stocks are up 20%, the easy money is often already gone. The market rewards preparation, not reaction. So what should a rational American investor do right now? First, review concentration risk. If your portfolio is heavily weighted toward high-growth tech that depends on lower interest rates, understand that higher oil prices can delay Federal Reserve rate cuts. Delayed rate cuts pressure valuations. This does not mean sell everything. It means know what you own. Second, consider inflation resilience. Companies with pricing power, the ability to pass higher costs to consumers, tend to survive energy shocks better. Businesses that rely on thin margins and heavy fuel usage struggle. Third, strengthen your household balance sheet. Higher gasoline and food costs squeeze disposable income. If your emergency fund is thin, build it. Volatility favors those with liquidity. Fourth, do not abandon diversification. Some investors think war equals buy oil only. Concentration is how portfolios break. Diversification is how they survive. Fifth, Think in time horizons. If you need money in 12 months, volatility matters deeply. If your horizon is 15 to 20 years, this conflict becomes one event in a long economic timeline. Now let's talk about retirement accounts. If you are over 50, this moment feels heavier. You are closer to retirement. You feel more exposed. But here is the truth. The greatest retirement risk is not volatility. It is abandoning growth entirely because of fear. If oil volatility keeps inflation elevated, retirees actually need some exposure to productive assets that outpace inflation. Going entirely to cash feels safe, but cash loses purchasing power. If oil stays elevated, inflation remains sticky. If inflation remains sticky, long-term growth assets remain necessary. That balance is critical. Now let's discuss what could happen next. There are three realistic scenarios markets are pricing. Scenario 1. Contained conflict. Shipping continues. Oil stabilizes between $85 and $95. Markets remain volatile but recover gradually. Scenario 2. Partial disruption. Shipping insurance costs surge. Oil moves above $110 temporarily. Inflation ticks higher. Rate cuts get delayed. Markets reprice growth stocks downward. Scenario 3. Major escalation. Supply disruption is real. Oil sustains above $120. Global growth slows. Central banks face a difficult choice between fighting inflation and protecting growth. This is the least likely, but highest impact scenario. Markets constantly weigh probabilities. They do not wait for certainty. And here is something many Americans overlook. The U.S. economy today is more energy independent than it was decades ago. Domestic production provides a buffer, but pricing is global. Even if America produces enough oil, global disruption still drives global prices, which means American consumers still feel it. Now let's go deeper into the market psychology layer. War headlines amplify uncertainty. Uncertainty increases volatility. Volatility increases trading activity. Increased trading increases mistakes. Retail investors historically underperform during volatile periods because they react emotionally. Professional capital reallocates calmly. That's the difference. The market punishes emotional urgency. It rewards structural discipline. If you are investing through a 401k, the smartest move for most Americans during geopolitical shocks is often the simplest. Continue automatic contributions. Rebalance periodically. Avoid dramatic shifts. That sounds boring. It is. And boring compounds. Now let's address something critical. If oil rises and stays elevated, it does not just impact inflation. It impacts corporate earnings. Transportation costs rise. Input costs rise. Margins compress. And when margins compress, stock prices adjust. But markets are forward-looking. If oil spikes temporarily, investors look past it. If oil embeds structurally higher, valuations change. So what should you watch? Not social media, not daily outrage. Watch oil futures, watch inflation data, watch Federal Reserve commentary, watch shipping flow in key energy corridors. Those are the signals. Now let's talk about the American consumer. Consumer spending drives roughly 70% of the U.S. economy. If gasoline moves sharply higher, discretionary spending slows. When discretionary spending slows, earnings in retail and services soften. Markets react. But here is the balancing force. American consumers are resilient. Corporate America adapts. Costs are adjusted. Supply chains reroute. Capital reallocates. The system absorbs shock, unless the shock becomes systemic. That distinction matters. And here is the uncomfortable truth. Markets often fall faster than fundamentals deteriorate. Fear prices faster than earnings, which means long-term investors sometimes benefit from short-term panic, not because war is good, but because markets overshoot emotionally. Now let me address the deeper financial lesson. Geopolitical conflict reveals who has margin and who doesn't. Households living paycheck to paycheck feel oil spikes immediately. Households with savings feel inconvenience, not crisis. Investors with diversified portfolios feel volatility, not devastation. Margin is protection. If there is one lesson this moment reinforces, it is this. Financial resilience is built before crisis, not during it. Now let's finish with perspective. Over the past century, markets have endured world wars, cold wars, oil embargoes, terrorist attacks, financial collapses, pandemics, political upheaval. And yet, over long horizons, productive businesses continue generating value. That does not mean there will be no pain. It means long-term participation historically rewards patience. This conflict is serious. Energy markets are sensitive. Volatility is real. But emotional overreaction is more dangerous than oil at $95. The question for every American investor is simple. Will you react, or will you operate from structure? Because markets do not reward fear. They reward discipline. And discipline is most valuable when headlines are loudest. The question is whether you move with fear or with structure.